Hey guys, JJ here. Welcome back for another Wednesday of Zoom networking. And I have a speaker today for you that is a special treat for you guys because this guy is one of the smartest guys I know. He's absolute genius when it comes to real estate, underwriting, um, just a vast array of topics. But just an absolute pleasure to call this gentleman a friend of mine. And now we're also working together. But I'd like to introduce you to my good friend Brian Fine. Brian, how are you?
Doing fantastic, JJ. Glad to be here.
Hey, really quick, for those that don't know you, where in the country you located?
I am in Pittsburgh, PA.
Awesome. Um, your topic today is researching and choosing the perfect market.
Yeah. So, of course, as a lender, we talk to a lot of people in our community here, and one of the things they express multiple times is nobody is teaching them how to do market research. So, we figured we'd sort that out for you today.
Market research, we get into real estate, we're new, we're learning how to do wholesaling, we're learning how to do rehabs. Um, and there's a market of properties out there. We have buyers, we have sellers, and available properties. But what are you talking when you talk about choosing the perfect market?
So, there's fundamentally two kinds of deals we can do. We can do deals that involve construction and adding value, whether that's a renovation or ground up. And then we can buy property and hold it, usually for income. And so those two approaches are going to have different market requirements. For the construction stuff, we it's a lot easier because there's a fewer requirements since we're not keeping the property long term. We just have to build something that somebody would want to buy. With the buy and hold, it's an entirely different story because now we're going to be in that subject market and dealing with the local government and the economics of that area for decades to come. So we got to be a lot more picky about where we're doing that.
Okay. And we've got a number of people on the call today. Some are newer investors, some are very experienced investors. What might you like to, how might you like to start out on your topic today?
Let's start out with the construction side, renovations and new construction, because it's just easier. So for starters, guys, in every real estate market in the country, every single one, there is somebody somewhere making money. So all markets can be profitable. You don't necessarily be successful as an investor the same way in each of those markets. So with construction stuff, the metrics are a bit simpler. So I'll kind of do this by rehabs, but it would be a similar idea if you're looking to do ground up construction. For starters, you want to look at what the median home price is in that area. And you don't want a home that's exceptionally high compared to that or a property. So in Pittsburgh, median home price is about 230. I don't want to be the guy with a $650,000 house because it's a more niche market. It's harder to sell that property. So I want to be somewhere near that median. Being below it is okay. Affordable housing is always in demand everywhere, but below or around the median home price is kind of your ideal for your fix and flip stuff and your first time home buyers who make up the majority of our purchasers when we're selling property. So that's big item number one. When you look at your comparable sales in the area, you want to figure out what normal is. So if everything in that zip code, in that school district, for owner occupant single family homes, school district is more important than zip code. But when you're looking at these two, you can kind of use them interchangeably. The comps will tell you what's normal. If everything there is a 3 bed, 2 bath, and you have a 2 bed, 1 bath, then you don't really want to try to put that on the market without increasing it to normal for that area. If everybody in this area has a detached garage uh, on their property and you aren't looking at a subject property that can have one, that's weird and a problem. We probably would pass on that. So unless you have no choice, I wouldn't buy that. And if I did buy it, I would get a substantial discount because I'm going to have difficulties when I go to sell it. Parking's a big one. Another one is any kind of weird shaped lot. If everybody has a quarter-acre square lot and yours is some weird octagonal thing on a hill somewhere and half of it as a sewage drain going through it. That's not something we're going to be able to fix with construction. So just go ahead and pass on those. Buy normal stuff. A thing we run into in my part of the world a lot is uh, Western Pennsylvania has a lot of hills, so we try to avoid properties that are on steep hills. Nothing good comes from that. There's just not a lot of those in the area. So figure out what normal is in the subject school district and zip code you're working in, and buy a normal property.
Brian, I got a question as far as uh, choosing the perfect market. I live in Los Angeles, and it's
Mm-hmm.
not a great investment part of the country because there's a very, very high buy-in and the returns are much lower. Other parts of the country have a lower return, lower buy-in and a higher return. And some parts of the country, like LA's got great weather. I love the weather here, but it's expensive. Other parts of the country have variable weather. Are How do we take these things into consideration as we're researching and choosing the perfect market?
As a rehabber or a new build model, you don't. We don't care. People are buying houses in LA. Why they're buying them, I don't really care. I just care what they're buying them for. With buy and hold, which I'll get to in a couple of minutes, JJ, you're absolutely right. All that matters and more. We have to take into account a lot more variables. It's a far more intricate model. But just a couple more things on the construction stuff, guys. It's fairly straightforward, really. Most of your underwriting covers what you need anyway. And we don't hold the properties long enough that we worry too much about property values changing. They're not going to appreciate in value or depreciate if the market happens to be going down in the window we're keeping them. Even in like LA is a good example. In 2008, it's a pretty good price drop, but that still took a period of about 2 years to happen. If I'm holding the property during that time for less than 9 months, I'm not going to see that much of a shift. And if I was conservative when I ran my numbers, I'm probably fine. It works. So for construction, that kind of stuff is not as big of a deal. We have fewer things to think about. But JJ, you're doing a rehab in LA, right?
I sure am.
How long's your permits taking you?
Oh boy, they're taking me longer than I would like.
Okay. Measured in months, right?
Yeah,
Multiple months.
measured
Okay.
in months.
All right. So let's pretend I was doing a property similar to yours. I bought it for, let's just say $2 million. Putting in another million five. And so that construction will take me, let's say, 6 months, but it's going to take me another 6 months to get the permits. So now I have a 1 year holding time plus whatever it takes me to actually sell the property on the other end. That's going to be a very, very expensive hold. So when I'm looking at my deal and I want to operate in this market, I need to account for that. Right. So it's just going to be the traits of that market. Of course, you can flip stuff in LA. There's parts of it that are a lot cheaper than that. But I probably still have to deal with very long permit times. So that's a factor to certainly keep in mind. You guys are going to want to know it. And that'll be true whether you're doing just a fix and flip construction or it's even worse with ground up. You can have multiple things.
Corell, you are on with Brian Fine. What's your question?
Hi, so you are speaking about construction, and I was wondering if someone wanted to create a mobile home park using land, would that be something that I would get lending for? I could get lending for? Hypothetical situation.
Yes. Yeah. There's financing products for that. You'll need to get first. You'll need to buy the land. It would be part of the down payment anyway. So you will need to buy and control it. It needs to be entitled, meaning the zoning has to be right.
Okay.
You'll need to set up the utilities there and all that, and then you would need to acquire whatever structures you're putting on it. So there's specific financing you'd go through for that, and then to the point we're making now, how long that's going to take is a huge part of what that deal is going to cost you to get into. Right, that process, depending on where you do it, can take months to years. So you want to have a very clear consideration of what does the zoning office look like in your
Okay.
area? How much are those permits? In a lot of places, they're not that expensive, but in some places, like where JJ's at, those permits can be very, very expensive, and they can modify your budget all by themselves.
do I have to have that all planned out when I come to you as my lender?
You're going to need most of it. Yeah.
The whole,
Usually you'll have a developer do that, or you'll buy the land already entitled.
I
So
think
that
it's
part's already
already
done.
entitled. Yeah, that
Okay.
part. And they have utilities. So,
Yep. Yep.
yeah.
Then that's the really hard part. So that part's done, and then you'll need a clear business plan for what you plan on doing there, and an idea of what all that's going to cost. And yes, we can underwrite it and get you there.
Thank you.
Debbie, you're on with Brian Fine. What's your question?
Hi, Brian. Thanks so much for being here today. I'm actually doing a flip right now, and I do have this question. So you mentioned not buying something strange, but we purchased this property in a senior citizen community, and it has 2 bedrooms, 2.5 bath, and there's a way that we could make it 3 bedrooms. So would that be good or no? Because most of the homes in the community are 2 bedrooms, I guess, because it's a
Hmm.
retirement community. But when we see one that says three, it's like rare home in Sun City, 3 bedrooms, two and a half
Yep.
bath. So would that be good or bad?
It's all on the comps. If everything in that neighborhood is a 2 bedroom is fine. If there are no threes, then the three may not add that much value. Won't be worth doing. But if your buyer is a senior citizen, they really like single level living. So if you got stairs and the only way to get to the bedrooms is to go up some stairs, putting in a first floor master makes a lot of sense. So think of who the buyer is as part of your scope.
Correct. No, they're all single story homes. So
Yep.
it just we were just wondering, I just was wondering how much more value that's really going to
It's
add.
Yeah, that's a comp question. It's if you can find 3 bedrooms in the same zip code and they are selling in a reasonable time and you can get more value for it, it's going to cost you some amount of time and money to put that third bedroom in. Do you
Correct.
get at least a double what it cost you, right? But if it cost me $20,000 to put it on, can I increase the price by 40?
Okay, great things, great thoughts. Thank you so much
Yeah,
for that. I appreciate you, Brian.
sure.
Thomas Hill, you are on with Brian. What's your question?
Hey Brian, how you doing, brother?
How's it going?
Oh, pretty good. I met you at JJ's boot camp a couple
Yeah, I
weeks
remember.
ago.
Hmm.
All right, cool. I wanted to ask you, do you have a base rate for your lending, and how would that be structured? Is there a certain price range or interest rise that what's your ROI? I guess I'd ask you on lending out.
On lending, it depends on the risk
Yeah.
profile. So the higher risk the deal, the higher return we have to get on it. The lower risk the deal, inverse. And then what we consider risk profile varies. There's a lot of variables there, and there's a market rate that shifts. That's why we quote each one. You can get a fairly decent idea what you're going to pay for yourself, but what's your credit score? How much experience do you have doing this thing, right? If you're doing your 50th flip, you're going to have a slightly better pricing model than somebody who's doing their first, right? So it changes a little bit. For your fix and flip stuff, I would expect to be in double digit interest rates. That's normal. I expect an interest only loan. I expect it to last a year. I expect to get 100% of the renovation and some percentage of the purchase price, somewhere 80 or less of the purchase is what you'll end up with, right? And then your interest rates and points and things, those vary. Depends on the deal. It floats a little.
Okay. Well, thank you. Yeah, that's great. Appreciate that. It helps me out a lot.
Yeah,
Yep.
Tommy, let me jump in on it. And this pretty much, I'm just going to reiterate what Brian said, is that every single deal is
Yeah.
different. Every property is different. Every neighborhood is different. Every borrower has a different amount of experience. Uh, the experience of two people might be the same, but the neighborhoods are different. The houses are
Yeah,
square footage is
this
different.
the state we're operating in will have different laws, and so there's different costs involved. For example, it costs more to do a loan in California than it does in Pennsylvania by a large amount, several $1,000s in origination fees just on because of a state difference, right? So that won't be the same between any of them either. So you'll get each one quoted, and as long as you're operating in the same area, you're going to have a pretty good idea what that is.
So, Brian, there's a vast number of aspects to our topic today. which is picking the right market. Is it preferable to get in your own community? Or is that purely
For
dependent
for
on opportunity?
for construction, it's almost a requirement. You need physical proximity to the project. So wherever you happen to be, you can flip houses. There are or do new construction if the math makes sense. Which to me, a new construction project is just a big rehab. So you can do that almost everywhere in the country. It works. There's always depressed property somewhere. There's always stuff you can put into it to make it worth more and sell it. As a fix and flipper or new construction guy, you make all of your money on speed. Most people think it's how you buy it, but that's you just don't do that part too wrong. It's all in how long the project takes you. Every single day we hold a project, we lose money. So when I first started out flipping houses about 15 years ago, one of the things we did was figure out our per diem to hold the property. So back then I would spend $150 to $200 a day in interest, utilities, taxes, insurance, and construction, right? All these things that had to be done. So every day that I took to get that project done, I spent a couple $100s. So how quickly I can get that project finished on the market and sold basically determined my total ROI, right? When you borrow money, if I'm borrowing money at 15%, for example, but I only have it for 6 months, I only paid 7.5% interest. Not so bad. But if I have it for 18, that's 20-something% interest. That kind of sucks. So the longer we keep these things, the less profitable they are. So when we're looking at our initial markets, when you're looking at your comps and doing your research, one of the major factors you want to keep an eye on is days on market. And when we're dealing with days on market, everything is rounded up to the nearest 30. So 30 days is a month, but 31 days is 2 months. That's a 60-day.
Exactly. If it's a month and 10 days, it's 2 months. If it's a month and 2 weeks, it's 2 months.
Yep. Because your bills are due on the 1st. So as soon as we cross over into that next month, you have to pay another month's holding cost. Right? So when we're looking at our days on market for our comps, if I got a market where things are riding at 40 days, I know it's going to take me 60 days just to get an accepted offer on that property. And then the average FHA owner occupant is taking 45 to 60 days to close right now. That means if I took 60 days to accept an offer, I got another 60 days before they can close and I get paid. So I got 4 months of holding just to sell the asset. Then however long it took me to fix it and get it on the market in the first place. So we see an average of 9 months close to close on a rehab and an average of 14, 15 months on a ground up. Okay. And of course that can vary, but that's just your averages across the country. So take a very close look at what your timeline is. If you took on a bigger construction project, it's going to take you longer to do. Longer means more holding costs, means you make less. Right? This is why everybody prefers to do smaller construction projects. As lenders, if you're doing a large construction project where you're adding square footage and that kind of thing, that dings you on the loans to value or the interest rate, depending on the property. Right? If you're doing what we call an upside down rehab, we consider those high risk projects. That's where the construction is more than the purchase price. That's another hit. So I'm not saying don't do those things. I'm just saying there's costs associated with it. So when you're looking at your market, if the only way you're finding a deal is if you're buying it for less than you're going to have to put into it to fix it, just know that that is a higher risk project and it's going to lead to some changes in your financing for that project.
Bob, you're on Brian Fine. What's your question?
Hey, Brian, I was just wondering, I did meet you when you were out in California. I was just wondering, how do you expect AI to affect everything we're talking about, everything from real estate investors to, real estate agents or anything else?
Oh, that's a deep question, Bob. Deep question.
Sorry.
No, let me try to give an extremely brief answer, but this is a separate lecture on its own right.
Yeah, probably not in the best
Yeah.
setting for that, but
So as of now, the consumer available AIs, Grok and ChatGPT, essentially have a PhD in every subject known to man. By this time next year, they will be smarter than any human ever to live. Within 3 years, they will be able to do every white collar job known to man better than any of us ever could. It's already a
the
tool that we
question.
can use to do it. So, and then it's the question is how does it switch to blue collar? And that's robotics, and that's coming pretty fast too. But just as a factor of economics more than anything else, one of the last things to be replaced will be residential construction. It's going to take too long. So on that note, we have, I think, a little more than a decade before our world completely switches over. If you got any kids, they better be learning to be a plumber, HVAC, electrician, some sort of trade. That's where the money is right now. If you're sending them to college, you're insane. That is a terrible move. I wish I would, if I could regress 25 years in life, I would immediately go get a apprenticeship as an electrician or a plumber instantly. That's the way. But to the broader point, Bob, I think we are probably the last generation of real estate investors. That model, the way we know it today, probably won't exist in 15 to 20 years. So we're in the last batch.
So
the good
you
news is we have
basically
enough time
need to
for
utilize it right now
yeah.
while you can.
Yeah, we have. I think we all have enough time to hit our wealth goals, but we don't have an excessive amount of time. I don't know that we have 30 years, but 10 to 15 we probably have before our robot overlords are changing the game a little too much to predict right now.
Right. Well, thanks for your answer and thanks for your time, man.
Yeah,
Hey,
thanks, Bob.
Bob. Good to see you, Bob. Mr. John Santolicito, you are on. Brian, what's your question, John?
Hey Brian, how are you?
Doing fantastic. How are you, John?
We spoke earlier in the year. I don't know if you recall. Anyway, I'm getting a lot of leads and a lot of opportunities to take down sub two deals, and some of them are really sweet. And uh, uh, I don't want to assign them. I want to buy and hold. And I'm having a hard time finding PML for sub two deals.
Mm-hmm.
It seems like there's a big when you go second position lean, everybody starts getting very skittish about that. And I was wondering if you
Correct.
could speak on it because I'm a very conservative underwriter,
Yep.
And I like my deals. I like the way they. But I'm really having trouble finding PMLs,
Yeah.
at least for 12 months till I can get it stabilized and
Right.
and you know put a DSCR on it.
Right. The major reason is because it's extremely risky.
Well, it's
No matter
not
what
more risky than upside down deals.
maybe. Here's the way it gets looked at. So if you're taking the property subject to an existing mortgage. You're creating what we call a technical default. It means you broke the rules. Whether or not you get caught is not the point. It's already actively broken. Should that lender call a due on sale, your second gets wiped out big time. So that's almost random. Some of them, like Fannie and Freddie, don't tend to call them that much, but they are now. They're calling them. You can probably, it won't take you too long of calling around to find a few people who are actively dealing with due on sales right now. So that as a structure has problems and causes risk because of that. Another thing that happens, do you know the legal term function over form? You ever heard that before?
I've heard it.
It's usually talked about with the IRS, but it kind of applies in all civil proceedings, which anything like a foreclosure is considered a civil matter. So function over form essentially means the form is the paperwork. Did you follow all the rules and check all the boxes? Function is what you intentionally did with it and what was the outcome. So the major problem with sub 2 is that if your seller ever decides you screwed them over or just decides to screw you over and takes you to court, they're going to win. They're going to win fast and you're going to lose bad. So it doesn't matter what the paperwork said. You're not going to get to keep the asset. They'll be able to strip it away from you. So as a structure, it's extremely risky, and that's a difficult thing to sell a private lender on. That's really what it gets down to. In general, we want to kick the seller out of a deal as fast as humanly possible, or force them into second position if they're dumb enough to take it. Place a first, that works too. It's just considered very, very high risk.
So do we need to change the dispo strategy? I mean, sub 2 is, I've heard it said that they, if your seller decides at some point, he doesn't like you anymore and he calls the bank and rats you out, you put in the closing paperwork, you can put a $50,000 default judgment against him if he does something like that. All that's out the window.
If they called the bank, that would be the best outcome. The outcome you're going to get instead is they're going to call a lawyer, and the lawyer is going to destroy you. You're going to lose.
Okay.
And you can put anything you want in the paperwork. You're not going to win. Because here's their narrative. It's really, really simple. This unlicensed real estate professional called me up, made all these promises to me, said they were going to buy my house, did that, and then it turns out that I still have a mortgage I still owe on it. They expect me to leave, and I'm getting screwed over here. They stole my house. How did that happen? It doesn't matter what any of your paperwork says. That's going to win in court. And then the lender is going to be involved. And what's the lender going to say? You both just did something really stupid. Pay me back today. That's the underlying problem with this structure, guys. Subject to the existing mortgage is a technical default. You're creating a business model that is against the contract. I'm not saying you can't do it, and I'm not saying you can't get away with it. We've done it before. It's just really high risk. So at best, I would treat it as a bridge loan, and I would have enough cash on standby to pay it out the next day if I had to. Okay. That's how to do it stably. But if you have enough cash to do that, kick the seller out of the deal. They get emotional and crazy. Get them gone. Get them gone fast. Right? Does that help, John?
Thank you.
Troy Caudell, you are Brian Fine with your question.
I just had a quick question regarding actually choosing a market. How do you balance the numbers and your gut? In particular, like choosing a market that looks really good on paper, but just doesn't feel right.
If it didn't feel right and look good on paper, I'd pick another one. That's me. Especially if we're talking about well, actually, it doesn't matter what we're talking about. I wouldn't do it if I didn't like it. I wouldn't do it. There's lots of choices out there. Pick another one. You'll find one that doesn't give you that heebie-jeebies. Yep. Exactly.
Is that your question, Troy?
Yeah, it was just a simple, easy question. I was curious about how he dealt with it.
Yeah, and I agree with Brian. It's got to feel right. My first deal was the one I didn't do, and they say sometimes the best deal is the one you pass on. And first one that came across me was right in the beginning of COVID. When COVID broke out, what looked like a deal didn't feel like a good deal anymore, and I backed out of it. And the next person that picked that deal up lost their ass. So. Yeah,
yep. There's markets in Pittsburgh that the whole time I've been growing up, that's been the kind of place you didn't go. And today there's a Starbucks on every corner, and I probably can't afford to invest there. But to me, that's still a bad area. I don't care what the numbers say. I won't go there. Not my money. So
sounds like
look at it.
In parts of Indianapolis, it's just like
sure
certain parts I won't go to,
and that's fine. I'll talk about this more with the rental stuff, but it applies to construction too. I think a really good standard is if you aren't comfortable with your wife or daughter walking around the place in the evening, it may not be the best place to invest your money. Just a
That's
just
kind
a
of how
pretty simple baseline there, guys.
That's
Just
pretty fair.
that's
yep.
kind of how I've been looking at. If I don't feel safe in the neighborhood walking around, I won't put a tenant in the same situation.
Yeah.
Correct.
Good man.
Correct.
Brian, we have a question from Shell. Shell, you're on with Brian. What's your question, Shell?
Hi, I am curious. I was listening to you talk about the whole construction time frame and that kind of stuff, and the fix and flips time frame and that kind of stuff. And I have a couple situations that I'm in where one, the time frame has definitely been sitting there. It hasn't been moving per se. It's kind of in a deadlock because it was over leveraged. The property was over leveraged. And so, in an over leveraged position, is there a way to ever get out of that? And then I have a personal project that someone brought me into. It was a single fix and flip that appears to be over leveraged as well. And so I'm trying to figure, like, obviously, I'm done doing some of this stuff entirely, but I'm trying to figure out, like, is over leveraged a regular thing that people run into a lot? And is there a way to deal with over leveraged options?
So it's the whole ounce of prevention is worth more than a pound of cure. So is over leverage normal? No, no, it is not. You should not be over leveraged. You should not be getting into any of these projects either as an investor or as a lender without having a proper appraisal done on the subject asset. Whatever that ARV is, there is no universe where your money should be over 75% of that number. Don't do it. You won't make money. If you find yourself in a position where you are past that, then as the investor, get out of the project as fast as you can. Finish it, sell it, and lose your money. And then go do another one and make it back there because that one's already dead. As a lender, it sucks a lot more because it now comes down to either the character of your borrower or whatever your lawyer can do. So the character of your borrower, and everybody on the call, take this and write this behind your eyelids, maybe tattoo it on a pillow or something and sleep with it. If you borrow the money, pay it back. Pay it back every time. I don't care if you have to go get a job pouring coffee for 5 years. Pay it back. Don't not pay people back.
And I'm wondering, is there, like, when you're looking at lawyers for things that happen, I've been told numerous times the lawyer is the only one that gets paid.
You can get the asset back. You can get a summary judgment, that kind of thing. So in the end, again, it's best if they're used as a threat. It's actually best if you don't get in the situation in the first place. It's second best if you can threaten or the borrower is just going to do the right thing and figure out how to pay you back and make an agreement with you. Next after that would be the lawyer threatens them and they come to the table and make an agreement with you. And worst of all is the litigate. Last, you lose the money.
Okay.
That's kind of the order.
So when you litigate, you will lose the money though, yes? I mean, as a matter of fact, even if you were led astray, you will still lose the money because you'll end up having to pay the lawyer and everything else, correct?
Well, yeah, talk to the lawyer. Find out what's involved in that. It depends if they fight back or not. It depends on whether you can get the asset. There's a difference between being in a first position and being in a subordinate position. So what's going on there, right? If you wait long enough and you're not in first position and the first position takes the property because the project's failing, you get wiped out. So it's definitely, if the borrower is not communicating with you a method of paying you back in full, then it's probably time to call the lawyer and get the paperwork started.
Okay. And then given that you have a house and it has been over leveraged because you went through 3 contractors that were crap, does it hold value to hold the property for any length of time? I mean, not so much if you don't have someone in it, right? I mean, can you turn a reconstructed house with over leveraged cray because you had contractors that you were not handling, that your partner was handling, and those contractors were trash. Is there like, I'm just trying to figure out, like, is there a way
So
to safely like rise above the situation?
yeah, so answer one, if it is in a place where cash flow is possible, then converting it to a cash flow asset and just getting it to be cash flow neutral. It's fine. Put somebody in there, rent it out, and wait until the market saves your ass in a couple of years by the property appreciating. It can work. Another answer is to just liquidate it and take the hit. Go to your lawyer, work out or not your lawyer, your lender, work out a payment plan for liquidating that asset, whatever has to happen to get it off the books, because they don't want it back either, right? If the construction is not finished, it's worth nothing to anybody. The project must be done. It has to be sellable and livable. So that has to happen no matter what. And then yeah, that's pretty much how those go. It sucks. Usually what I recommend doing is getting another one immediately and getting into it and letting the check from the next one pay for the sins of the previous one.
I just
That's how I've done it.
I like your voice. I like your affirmation. I like your you're just very confident. You're not egotistical confident. You're just confident. Like you have good thoughts, good understanding. You've done it enough. You know what you're doing, and you're just very affirming. So I appreciate that.
Thank you. Unfortunately, I'm speaking from experience. So
Yeah. Shell, thank you so much for joining us, Shell. Christopher Espinosa. Welcome, Christopher. Hey, what's your question for Brian?
Hey Brian, this is Chris. I was just saying if a private money lender could able to close on a on-market property that is listed with a realtor.
Oh yeah, completely.
Yeah, because I had spoke to some people and they were telling me no, you need a cash buyer, and they was trying to make me feel like yeah, you do need a cash buyer.
No,
No.
it doesn't matter. The only difference between cash and financing is what you put in the contract. The contract either has a mortgage contingency or it does not. That's the only difference. And so if it doesn't have a mortgage contingency and you fail to close, they get to keep your escrow money deposit. If you do have a mortgage contingency, and let's say you're working with me and we get up 20 days into the thing, and for some reason you're not going to be able to get a loan for that property, then you could use the mortgage contingency and get your escrow money back. That's all it means. That's the only difference between those. So it's just a contract item. All right, so rental side is different. You may want to write this stuff down because all markets are not created equal when it comes to buy and hold. We have a bunch of no-go zones, really obvious ones. So the very first thing you want to look at happens at the state level. You want to look at the State Landlord Tenant Act. And that's going to tell you how long, you can read them, most of them are in mostly plain English. How long does it take you to take possession, that is a legal term, of a property for non-payment of lease? And if that answer is not within about 30 to 60 days, you can write off the entire state, as in don't invest there. I'm not going to do it. I can save you guys a little bit of time. That's the entire West Coast. No California, no Washington State, and no Oregon. Don't do them. They don't work. Their landlord-tenant laws are awful. Everything north of Pennsylvania doesn't work either. You can write all those off. New York, New Jersey don't work. And that's all strictly based on their landlord-tenant laws. They are very, very tenant-friendly and business-unfriendly. In those states, you can have a tenant who stops paying you and they can potentially stay for years. So you want to watch out for that stuff. We can't underwrite to the risk of a tenant not paying us for years. There's no universe in which that works. So that is your very first thing. Can you enforce your property rights? Number one. Number two is one that you will hear from me and probably not many other places that you'd ever learn this stuff. Number two is population density. So we want population density. Most of you guys are probably familiar with political maps. They got the blue and the red everywhere. Take a look at a map that is a population density map in blue and red instead. And you'll see that they're very similar. Below a certain population density, it's about 600 or so, there's an extremely high chance that's a business-friendly conservative area. Above about 900, there's a very, very high chance that is a liberal urban type area. So it's just the population density. For us as buy and hold investors, we do need some population. If I'm in the middle of the desert in Nevada, I'm not going to get a lot of tenants, even if it's a really nice house. Population of 1 per square mile, right? So we're usually looking for stuff above 600 as a minimum. All right. We don't want stuff that's super rural, but there's a cap. Once we see areas, and this is census data, you can look this up for everywhere, just off the census.gov site. Once you get much over 3,000 people per square mile, we tend to see local governments doing very not business friendly stuff. That's where you start seeing those progressive, unfriendly policies. You get over 5,000 or 6,000 a square mile, and you probably need to exit the market. So when you're looking for your buy and hold area, first pick a state based on your landlord tenant laws. And second, when you're looking at your population density map, we usually want to be on the outskirts of the cities, not usually in the middle, where the population starts to drop off. It's the suburbs is where we prefer to invest. That's your BC middle class stuff. It's going to see the highest appreciation and have plenty of people on it. So that's a big thing to look at. Now, what a lot of people will teach you is as long as the population in the area is growing, that's a good thing. And that is sort of kind of true. But I have that critical threshold of about 3,000 where I would start to liquidate my properties. So if I'm in a market where, let's say I'm at 2,000 people per square mile, and they tell me that population is growing by 10% a year, which suggests a lot of growth in the area. There's a few cities in the country that are like that. To me, that means I can only be in that market for about 5 years before the government switches against me and I'm going to need to sell the assets and leave. So if I'm looking to hold property for longer than 5 years, I would write off that area based on that. So when I said there's not a lot of people who talk like me, I'm one of the few who will tell you the population growth actually has an expiration date. Same thing, a bunch of people moving out can be a bad thing too. That's generally considered really bad, but a little bit's okay. I don't mind. If it's losing 1% a year and it has a population of, let's say, 1,000 to 1,500 per square mile, cool. It's going to take it quite a few years before it becomes really bad on me. So that's okay. What we're usually looking for is relatively flat. We want the boring markets. So JJ mentioned weather earlier. Weather can be a real pain in the ass as a buy and hold investor. For example, if I'm on the Atlantic coast of Florida, then every couple of years a hurricane is going to come by and blow my little house down. So I'm going to have to carry a significant insurance policy to rebuild that thing every handful of years, plus go through the trouble of dealing with that. That's not going to be a very passive process. So while I could potentially get great cash flow there, that would be something that's inherent to that market I'm just going to have to deal with. California loves their wildfires, right? It's burned down whole sections of the place. So you may want to get fireproof houses, and either way, you get the insurance policies to go with them, right? So look at your natural disasters. The Midwest is a very popular place to invest in cash flow. Watch out for Tornado Alley. It's same thing as a hurricane, right? I don't care what actually caused it. If a big bunch of wind comes and blows my roof off, I still have to go through the insurance claim and issues of doing it. And God forbid somebody was injured. And then we have to deal with those issues as well. So looking for places where you know about the weather and have accounted for it correctly. I'm not saying don't invest in those places. I'm just saying the weather is real. I invest in Pittsburgh. We have all 4 seasons. So there's no natural disasters, no earthquakes. We're too hilly to have floods, but we do have all 4 seasons. The temperature changes cause things to happen. So we have to account for that in our maintenance. So want to keep an eye on wherever you're looking. Bear in mind the weather and any natural disasters that you might need to account for. It is okay to buy property in a flood zone. It's fine. Just know that someday it might flood. You would need to carry the flood insurance. And then you're going to have to deal with the insurance company when, your house floats away.
Now, Brian, wouldn't it just be easier to like look for property that's a little higher up? I mean, there's a lot of coastline communities, not only in, the States, but around the world, and people are
Yep.
investing in Europe and in the Philippines and things like that. Wouldn't it just be a little bit more advantageous to just err on the side of caution, just get your property a little bit higher up if you're even near a flood zone?
It can be. And that brings me to my next point. It's the economics, right? If I wanted to buy a property in LA on the top of the hill, is that going to cost more than one at the bottom of the hill, JJ?
Just a little bit.
Yeah, by a multitude, right? And so, can I cash flow that property? The answer is probably no. It doesn't really work. So, in commercial real estate, it's politically incorrect to say the ghetto. And so they instead created neighborhood classes. This is a formal designation. You have a Class A neighborhood, B, C, D, and E. Class A is your high-end, upper-income zip codes. Class B is upper middle class. Class C is lower middle class. Class D is low income. And Class E is either blasted out war zone or industrial area that doesn't have residential in the first place. So as buy and hold investors, the Class A and the Class D are both specialties. It's not that you can't make money doing them. It's not that they don't work, but they are very specialized. Class A stuff is higher risk to economic downturn. If we have a Class A property and we see a bit of a recession come in, then the Class A tenants, the people who can afford to pay thousands and thousands of dollars a month, they can move to a Class B area very easily and be happy. So your Class A properties end up vacant. Also, it's very hard to buy Class A that cash flows. So usually we call those capital retention. You're buying them mostly for tax purposes, not for cash flow. You're going to get a bunch of losses out of them. When you leave them to your kids, they'll cash flow them, but they can be a significantly longer play. Class B and C, that's our sweet spot. That's where I buy my properties. That's where most of the people you would call landlords buy theirs. We rent to the middle class. Class D is your affordable housing, lower income stuff. Again, it's a specialty. The cash flow on those looks better on paper than anything else, but the tenants you're after are the least financially stable, so you have the highest risk of not collecting that in the first place. So that's your neighborhood classes. You want to buy in places that you can cash flow. So that usually means for a single family house, you can buy at a 6 to 8% cap rate versus what it rents for. And for multifamily, that's 4 to 6. And you should be able to get that pricing straight off the MLS. It should not be a big mystery or hard to find. You should just go look at a couple of listings and be able to buy those properties for, about 100 to 150 times what they rent for each month. All right, so that's the big stuff on picking a rental market. One more, and this one may be the most important, actually. You need professional management. So if you've identified the world's most perfect market, but you can't find a good property manager, then that market is useless to you. You can have a very shitty property, and a great property manager can make it work. You can have an amazing property in an amazing market, bought the right way, financed the right way, and a shitty property manager will still ruin that investment for you. So we have to have a good property manager who's familiar with that asset class in that market. So definitely locate a good property manager before you start shopping for assets in that market.
Yeah, Brian, let's say we own property locally. We bought, we're doing fix and flips, and we decided to keep some of those.
Yep.
What's your perspective on managing as an owner versus engaging with the property management company?
Don't do it as an owner. So you're still held fundamentally to the same standards as professional property manager, which means you are expected in court to know and adhere to all landlord-tenant laws and all regularly updated case law. You will be sued. It's just a question of how long before you get there, and you're 100% liable for all that. There is no reason you want this. Plus, you're dealing with the tenants, the toilets, and the trash. I don't know about you guys, but I don't like working for below minimum wage, and that's about what managing property is worth. So instead, you hire a professional just about everywhere in the country. That needs to be a licensed real estate broker. They carry separate insurances for this. They're required to adhere to that. They take a lot of the liability on, and they're dealing directly with the tenant. You can search around for it a little bit. There's a couple of stories a year of some landlord getting killed by a tenant. It doesn't happen super often, but it does happen. There can be a physical risk there. So this way, they never even know who you are. So absolutely use professional property management. As a lender, when we underwrite your asset for DSCR, we're going to account for professional management whether you did or not. It's factored in. So you're paying for it whether you choose to use it or not.
Robert, do you have a question for Brian?
Yeah, my question had to do with a mobile home park. I was thinking about maybe purchasing a piece of land and put some mobile homes there because I was thinking it might be less expensive per unit than building, let's say, a fourplex. And I wanted to have his take on it, what he thinks about that.
So it's very difficult to finance them because they're not houses. Until you put them on a permanent foundation, on a permanent lot, they are not the type of thing that we get mortgages on. They're something else. Depending on how the state defines them, and this is different in every single state, they can be defined as vehicles. They have wheels. It's like having a truck. So it's its own rule set. So it will very much depend on what state you're doing it in and what kind of financing you can get for it. Is it cheaper per unit? It could be, or not. It depends. So that's something you'll have to do some direct numbers on and get your underwriting, and then speak to somebody who finances those. So we don't actually finance mobile homes unless they're on a permanent foundation. Then it's just considered a manufactured home, and it's fine. It's the same as every house. But unless you plan on putting them all on permanent foundations, you'll need a different lending source. And most of the time, those are lower loan to value. So while the dollar amount may be lower than building a fourplex, and even that's kind of iffy, depending, there's every chance that the financing will be worse and it'll cost you more out of pocket. So investigate accordingly and see what the math makes sense.
Dennis, you are on with Brian Fine. What's your question?
Hey Brian, nice to meet you. Just as a follow-up to this question previously, so I guess the same would apply to RV parks. I'm assuming, correct?
Correct.
In terms of
that's the financing on them. I actually know it's not super terrible.
yeah.
So that can work. If you want to create your own, that's a ground-up project, and so it's so you get your ground-up construction loan, and then you would convert that to a long-term DSCR. There are lenders who do it.
But if you're looking to purchase an RV park, is that a different financing wise than a mobile home park?
Yes, if you don't need any construction.
Okay, but what I'm just curious because what's the RV parks? They're not on permanent foundation. I mean, they're just RVs. What is the difference? How is that classified? Is it different?
I have capital partners who do it, not me, so I don't actually underwrite them.
Okay.
So I know you can get a 30-year fixed on it.
Okay, good to know.
Actually exists. Yeah, so they aren't too terrible either. You just got to have the liquidity for the down payment. And they're rated in stars, 1 to 5 star. So the better the star rating, the better the terms you'll end up with. Most of the ones you're probably looking at to buy are 2 or 3.
Mm-hmm. Okay, good to know. Thank you.
Mm-hmm.
Dennis, thank you for joining us today. Appreciate you being here. So, Brian, just to surmise, we've been looking as far as, picking a market, researching and choosing what's going to be the perfect market for us, going to be from a buy and hold perspective and for a rental perspective. And those can differ even within the same community. Is that correct?
Yes. Yeah. You can be good on one street and bad on another. It can be very, very close, like down to next door. That local market knowledge You either get through experience, or the best way to get it, I guess, would be to outsource to local property managers who can give you the information on that. Like, hey, this area rents really well. These are good properties to deal with. Most of those property managers, like I mentioned, are real estate brokers as well. So they're an excellent source for properties. They can either sell you stuff straight off the MLS, or maybe some of their clients are looking to liquidate some stuff, and you can pick up existing assets that way. So it's a really good way to get into a market if you identify a solid property manager. Very, very important thing.
There you go. That's excellent. Yeah. Yes.
Let's do one more thing here, one more factor.
Sure.
So as a lender, we're a member of what's called the NPLA, the National Private Lender Association. And so private lenders, it's a $55 billion a year industry. 40 billion of that 55 billion runs through 10 companies. Those 10 companies are all friends, and they all move basically in lockstep. All their money costs the same, all their products are extremely similar, and all their data is shared. So when they make a change, JJ and I at Always Capital, we are a tiny, tiny piece of the other 15 billion. We tend to follow the big 10 because their $40 billion has a hell of a lot better data than we do. So as of this month, there are some changes made in financing guidelines. Several members of the Big 10 are not lending under any circumstances in Philadelphia, the 5 boroughs in New York City, or Baltimore. And they're getting real iffy on Chicago. And that is due to a combination of fraud and a high default rate. So what does that tell us as investors? Why do we care? Well, it's going to be a little tougher to get financing there. You'll either need to use a bank who doesn't know this stuff or care about it, or you'll need to use pure private relationship capital to operate in those markets. But should you, even if you can, you got a $40 billion, $55 billion a year industry saying this is a bad idea, stay out. When they get to the point where a loan defaulted and a foreclosure is happening, do you think the investor is making money? Or did they already get destroyed? They've lost their shirt, credit score is done, they have no money left, they have been absolutely wrung out, and now a foreclosure happens is the last resort. So if we're seeing elevated foreclosures, another way to read that as an underlying is if you invest here, the chances of losing money are unusually high. And that's a function of that market. Hopefully it'll change. Maybe it'll get better. Maybe it'll get worse. I don't know. I can just tell you that as of this month, your billion-dollar companies aren't willing to spend any money there because it's too risky. So that kind of stuff happens too.
And again, I don't know, but would part of that be due to crime? I mean, Chicago has a history of, the mob era and crime and politics, and Philadelphia being a tough city, and, the boroughs of New York being, tough inner city, Baltimore being a tough place. Is crime at all also involved in these perspectives, these analysis?
It's certainly a correlation, though at least from a lender standpoint, they're far more concerned about financial crime, right? They don't inherently care if the property is getting shot up on a daily basis, as long as somebody is still willing to pay for it.
Mm-hmm.
But what we're seeing is that clearly people are not paying. Money is not being made. Is that because of crime? I don't know. I'm sure it's a factor. Fraud is definitely a factor. The big thing is to just keep in mind that if the really, really big investors are not operating there, you might not want to either. A classic one that I hope none of you are investing in or considering investing in is Portland is gone. That is not a city that real estate investors put money into right now. There is a very large skyscraper there. I forget the name of it. It's part of the skyline, really big deal. It sold for $325 million and was financed in 2020. It just sold on a foreclosure sale for $15 million. That is a pretty big loss of capital. If your really nice skyline buildings are doing that, how do you think the local businesses are doing, and how do you think the associated residential properties are doing? So that's not a city to invest in. Hasn't been for years, but that's a pretty well-known one. Minneapolis is another one that has quite a few problems. When you're looking at your markets, keep this stuff in mind. I'm not saying don't do it. There are certainly people making money in these markets, but the predominant data shows us that it's a higher risk.
So, Brian, if people are looking to do business in these areas, they're oftentimes looking possibly to get in with a lender to provide them the funds for their opportunity. It seems to me a lot of lenders are just going to be like, yes, I can get you the money. Yes, I can get you the money.
Mm-hmm.
Not always evaluating or underwriting the opportunity as a more experienced lender might do.
So you're all right. Let's talk about lenders for a second in the lending industry. At the top of the food chain, you have the 10 major mortgage originators. Parallel to them and a lot smaller are folks like JJ and I, Always Capital. We run a little fund and we lend our own money. And we also will broker to the Big 10. Below those Big 10 are about 1,600 broker shops. And that number is basically anybody big enough to do it as a business instead of a hobby. And that's nationwide. Those guys have none of their own money. They're strictly working on everybody else's. The experienced ones will know what the requirements are for the people they broker to, and they will be able to get you your loan or tell you it's not going to work pretty fast. Inexperienced ones who are just trying to get a deal done and collect a commission, yeah, they're going to tell you they can get you the financing. They're going to promise you the moon, and they're going to fail on the 29th day. So that can be a problem, and maybe that's a subject of another call. But when you're looking for financing, stability is one of the most important factors. You want somebody to tell you no fast, and if they tell you yes, you need them to perform. So that's what we try very hard to do at Always Capital. So we do our best.
Shell, you're on. Brian, what's your question, girl?
Hi. So how do you get into your lending, or people can get into the lending, right? Or how, like, you're lending money out. Are you just mainly lending from who? From what? Like, I'm just wondering if someone wants to come up beside you because maybe they're really scared or uneasy or have been burned or maybe.
Okay. All right. Great question, Shell. So private lenders, you Gator guys, we have a group. You can talk to JJ about it. We call it our Equity Investing Done Safely group. For free, I teach you guys how to invest and not lose your money. I don't charge anything, and we're not trying to sell you anything. It just, we don't want to hear anybody losing money. So we will share with you how we do it. But broad strokes, the best structure you can do is be an equity partner to somebody you intend to lend to. And you insist that somebody like me is in first position. So we're not going to give them all the money they need. We're going to give them, on a rehab, 80% of their purchase price, 100% of their renovation. They're going to need that 20% down, the closing costs, the monthly mortgage payments that we will charge every single time. They also need a little bit of money to do construction before we reimburse them. So they need a chunk of money for that. And then utilities, taxes, insurance, all that other stuff. So you, as an equity investor, can bring that capital to the party. But by insisting we're in first, we fully underwrote the deal. We wrote the biggest check. We said that the thing works. We share all the underwriting we did with you. So you get to get things like your business partner's background check. Be kind of nice to know if they committed financial fraud sometime in the last few years, right? So we do all that stuff. And while that doesn't guarantee 100% that the project works, following all our systems, you got about a 0.07% chance of it failing. So there's a very, very good chance that the project is completed, makes money, and everybody gets paid. So that's the simplest structure you can do in that. as far as being a safe investor kind of alongside us. It's more that you insist that we're in first position, because then we underwrite it. And since we're writing the biggest check, we take the risk.
And I can hear you and what you're saying about that, but I guess I don't know, still a little piece of reservation is like, I just did that. Like I just got beside someone who has like a big name, has been big in the lending, had like all this stuff going for them.
Hold on, let me pause you just a second. It's because there's a few baseline requirements here. First, was there an appraisal done on the property?
Yes.
Was the total amount of money, including yours, bring that to under 75%? That's huge.
No, I think so, because I think so.
Okay.
I do think so.
Yeah, then the way that what would happen in the event that the operator failed to perform
3 times, 3 different operators.
You would actually take the LLC. It would be yours now.
Yeah, it is mine and it's over leveraged.
Okay. Yep. And then the objective is to end the project as best you can. So why don't you schedule a call with me?
Yeah, that sounds
talk through
great.
what you have
Okay.
Let's do your specifics there.
Sounds good. Thank you.
Okay, sure thing.
Thank you so much, Shell. Yeah, guys, if you're looking to learn more about how to be cautious and safe and minimize your possible instance of error, you could do this one of two ways. You could roll all by yourself and work by yourself, or of course you could network with others. And we talk about joining communities, every education group, whether it's Burr, whether it's cold calling, driving for dollars, everything has an education platforms, and they all have communities. Um, but just because you're in the community doesn't mean you're going to have access to everything. It's how do you leverage that community, which means how do you build relationships with people that can help you. Jump in with Brian and myself. If you're interested in some of the things we're doing, please reconnect with us and let's help you with some of the foundation of what you're doing. And we're not looking to charge you, we're just looking to help people with knowledge and education. Brian, do you want to expand on that?
Yeah, we get paid to lend money. I'm not trying to get paid to coach you or mentor you, but I need you to be able to get qualified deals we can lend on. And when you have equity partners, private lenders, and those kind of things who help you do the deals that we ultimately fund, I never want to hear about those people getting burned. We want everybody making money and doing well and being safe and not doing deals that are, quite frankly, stupid. It's not hard to make money in this game, but you can get burned by just taking insane risks. So we take a very, very close look at the kind of risks these things carry, and we, advise accordingly with our own checkbook. If we don't think it's a good deal, we're not going to do the deal. We're just like, I'm out. I won't touch it. And I could maybe for Halloween we'll do investor horror stories or something. Let's talk. We'll tell you a bunch of scary ones. But on a weekly basis, I get brought stuff that is just insane. Hey, can you fund this? But dude, I wouldn't throw somebody else's money after this. It's just insane.
Yeah.
I'm going to lose money.
Number one question is, if people want to reach you, what is the best way to connect with you?
You guys can pick a time on my calendar and book with me.
Guys, here is the link for Always Capital. Chat one-on-one with us to see if we're a good fit. And the link is invest.alwayscapitalllc.com. Just like anything else, you can find a time to come on here, chat with us, and get acquainted. And that is the primary way there to see what we're up to.
For sure. If you guys have a deal, you need a quote on funding. The best way to do that, JJ will put the URL up for you. You can just submit that deal online. And then we say we'll get you a quote in 2 business days. But if you put something in tonight, I'll probably get it to you tomorrow. So we're about a day. But if you put it in at Friday at 5 o'clock, don't expect to hear from us till Monday.
So one of my last questions, as I always end up with, is my group's a networking group. I was talking about the importance of building relationships, networking, making ourselves visible. You've been in this game for more than a minute. You've coached thousands of people, been on multiple stages, dozens and dozens, not hundreds of stages. What is the importance of networking and building relationships to the success of the new investor?
This is a team sport. You don't do this in isolation. Your team members or your friends, which should basically be an interchangeable topic, uh, are who have the expertise you need. So who knows which city block and zip code is a good place to own investment property versus a absolute shithole and you'll lose your shirt. That's a local property manager who's highly experienced. Where do you meet them? You better network with them. Who's going to fix your properties? That's some contractors. They need to be local too. We better go meet them someplace. Who's going to lend you money? I don't lend money to people I don't know. So we got to get to know you, right? And it's a bit unfair if you think about it. You're going to call somebody up out of the blue who's never heard of you before in your life and ask them for a few $100,000. How do you expect that to go? You got to at least say hi. And then today, most of this networking is done online. That's just the way it works. So you're going to need a social media presence like JJ teaches. And then our experience is that usually leads to face-to-face. So at some point, you're going to shake somebody's hand and have a coffee, a tea, or a beer with them. And that's going to solidify your relationship and get you going. So first, they got to know you. Then they got to like you. Finally, they trust you. And when they trust you, they do business with you. So absolutely critical.
There you go. So
there is a way around it, though. If you already have a ton of cash, you can just invest that money at a flat return somehow. And you don't really have to speak to a lot of humans to do that. But unless you already have, for most of you guys, I would guess a few $1 million, that's not a valid answer.
if you guys are on the call, don't go away. We're going to move into a couple more things with us and more training and more networking. If you're watching our video right now, please like the video on YouTube. Please put in the comment section your takeaways, what you found informative. If there's something I could do to bring you better content, please put that in there as well. You can look for Brian on the website that we gave you earlier. And if you want to connect with me, scan the turquoise QR code. It takes you to my website. You can register for the group so that you get on our Zoom calls. And you can scan the purple QR code here, which allows you to subscribe from my YouTube channel. You have access to all of our training, all of our coaching, all of our guest speakers. So Brian, other than that, everybody else will see them in the world of virtual networking, right? Facebook, Instagram, and the website.
Absolutely. I look forward to having talks with each and every one of you and helping you get your businesses to the next level. Looking forward to it.
There you go. Hey guys, thanks for joining.
Thanks, guys.
Please come back again.